Good morning, everyone. Tim Nyland here. August 19th is the date, and this is our internal strategy call for Zacks Professional Services. Last week, during our call, I talked a little bit about the Consumer Price Index, and on Friday of last week, we actually hit another threshold and another green shoot in this economic recovery with jobless claims dropping below 1 million for the first time since the pandemic. And this is obviously a really good sign because jobless claims are obviously a leading indicator for continuing claims, which still is problematic. So we're going to look at several news articles that I've pulled out of the Wall Street Journal over the past week, again, to make this as relevant as possible for our users, our advisors, and portfolio managers that are listening in, and how they can utilize our systems to do maybe a little deeper dive into some of these issues. We are going to talk about Apple today as well. They obviously just hit the 2 trillion mark this morning, literally a half hour before we started this call. And so we'll take a quick look at them as well. But to get started, I'm just going to go into an economic chart that I produced this morning with initial claims. And if I take you back to the Wall Street Journal article again, great chart. I love to compare the initial claims, though, during the pandemic. You'll see that we just almost touched 7 million. Just to show everyone the scale and ferocity of initial claims during the pandemic relative to the financial crisis, which is what this chart does not show, I think is the real story. And you can obviously get from this scenario a good picture in your mind as to why the Federal Reserve literally just pulled out the stops and said, basically unlimited QE. So I want to draw everyone's attention to some options here in the Zacks Research System. And if you go under Tools, Options, and click on this Frequency tab, you can actually set the frequency mix between daily, weekly, monthly, and this controls the time series sampling, if you will, for all of the data in the system. And so what I want everyone to see here is that we are sampling more or less weekly history here, and we're going to be showing almost that 7 million in claims that the Wall Street Journal article shows. And we've also got the most recent data point as of last Friday, that 963 that came in. And where I'm going with this is I'm going to do a right mouse click on history, and I'm going to take us back 15 years. Notice that my peak for COVID initial claims basically gets cut by 3 million because I moved to a monthly sampling. And obviously we do this to optimize the speed of the system since it's remotely hosted. We don't carry that weekly series back that far, so we switch to monthly. But keep in mind that from a scaling perspective, this would actually be twice as high. And you can see how long the financial crisis actually carried out in terms of initial claims versus the spike of COVID. And I think that, you will get a much greater appreciation for the ferocity and response from the Federal Reserve after seeing this chart relative to what we went through in the financial crisis. We all lived that nightmare. And this one could have been literally, even worse than that in terms of unemployment had the Fed not kicked in and basically pulled out all the stops. So here we are, and continuing claims obviously continues to be an issue, but this is definitely a leading indicator of things on the mend and improving. So that's good to see. Next article I want to touch on is this article that I pulled out of the journal maybe over the weekend. I can't exactly remember when I did it, but it was definitely since our last meeting. And I want to call everyone's attention to this because I want to speak about this leadership group once again. I know I talk about it a lot, but I want to make sure that everybody knows that these that are obviously outperforming the entire broader market. I've got the S&P 500 circled in black here, and it's basically its performance year to date. And you can see all of our tilts minus Adobe, which is actually even, it's also outperforming the S&P 500. But in the newspaper article, the top 5, again, these are the top 5 names of the S&P 500, these mega caps that keep pulling the broader proxies higher. You hear about this literally every day. And I don't want people to get cold feet thinking, wow, this is just a completely overcrowded trade. Amazon has just absolutely killed it, up almost 75% year to date. Apple just hit $2 trillion. When's it's going to end? And again, these companies are delivering not only revenue growth but profitability. This is nowhere near what we experienced in the dot-com days back in 99 and 2000. And again, I want everybody to roll their memories back to March when we originally rolled out the calls for the tilts, and this top 5 leadership group had never even been mentioned in the media, CNBC, Wall Street Journal, or any of the like before we made the call. Okay, so we were here first. We made the call. We tilted on the ECP with these names for the reasons that I outlined in that tilt webinar. And here we are today. So what I want to do is just cherry pick Apple out of this group. And the only reason I want to cherry pick Apple out of this group is because it has had a tremendous price increase. In the last year and a half, it's literally gone from 153 when they cut guidance, and that's when I backed up the truck personally in this name. And obviously it's just crossed the 2 trillion mark, on its way even higher. So let's go into the research system, and I created a pitch book to go through some quick analysis on Apple. I named the pitch book Profit and Leverage, and you can see it up here. And this is just a great way, especially when I'm doing webinars. I don't have to constantly come up here to charts and just continue to fumble around in these menus. I can just literally bump through the arrows here. So the idea is that we can see this price action relative to earnings, and obviously we can see some of Apple's growth here tapering, accelerating. I love looking at this chart because we can actually see how Apple ebbs and flows against that earnings line in terms of price. So we get down to PE multiples of 10. We go through iPhone cycles, and all of a sudden we get this multiple expansion through these big iPhone cycles. And now we're into something a little bit different, okay? And we've got, obviously, the services business for Apple, App Store, everything else, which is really, really pushing this multiple expansion. But the idea here is that there's also other things that are going on, right? And we're going to look at that here in just a minute. Why would Apple's multiple be expanding at this type of rate? We need to take a look at maybe what's going on in the broader IT sector as well. And so if we look at the valuation model really quickly on Apple, this will give us a really good gauge very quickly as to how the sell side is actually valuing Apple relative to an implied bid from the buy side in terms of what growth rate is sustainable and supportable longer term for Apple. And so if I click on the default model, I recommend everybody do this anytime they go into the valuation model. It's just really important. You never know when you have looked at a company. Trust me, you go through, look at 5 or 10, a couple of weeks from now, you'll come back and say, I haven't looked at this one yet. But then you've got some stored settings in there. You got to clear them out. It's interesting to note here that the long-term forecast coming in from the sell side is about 10.67% growth. As a measure of conservatism, before we do any modeling at all, the default for the sell side, we take one standard deviation around that mean estimate and remove it. So we're going to set the fulcrum growth slope of earnings at 8.15. So that's going to be this number minus one standard deviation to come down that. And again, it's just to taper our expectations. And immediately my eyes come down here to the current model return, and I can see that the buy side is basically saying that if Apple's only going to grow at 8.15%, then the current model return is actually negative 22%. So I can see that the buy side has actually bid the implied growth rate of Apple up higher than 8.15%. And I can also see that perhaps that's supported here when I look at 2020 forecast EPS growth of 9% off of last year's actuals, and then 2021 at 24% with that 5G cycle kicking in and iPhone 12, and then 2022 kind of tapering back down a little bit. But perhaps there's more to that story. So what I want to do is actually solve for the market implied growth rate. I have a button up here that I can click on to kind of snap to that rate immediately. But what I want everybody to see that if Apple was only going to grow at 8.15%, the model's basically telling us they would be trading at a premium of 23. The actual PE right now is around 30. And so the model's basically telling us, hey, at 8.15%, we should be looking at a $360 price tag, and we're obviously at 468. So we've got to basically bring this model into equilibrium, and that we're going to do by solving for the growth rate that sets the current model return equal to 0. And all I'm going to do is I'm going to grab this model EPS growth tool down here, and I'm going to just literally click the right side of it. And when I do that, you'll see that every single click, the model EPS growth rate increases by 10 basis points. And as I'm clicking, you'll see the model return begin to approach 0, but you'll also see the model PE begin to approach the actual PE and the model price begin to approach the actual price up until the point at which the model return approaches actually hits 0. I'm going to click on the MIG to force it, and you'll see that the model PE equals actual PE, model price equals actual price, and we end up with an implied growth rate of almost 11%. So that's our hurdle rate. So if we as portfolio managers feel as though Apple is going to grow their earnings long-term at greater than 11%, perhaps we have a buy. And so if we toggle to the next view, this is the view that I prefer to use to look at issues related to the sustainability and supportability of growth. And the first thing that I'm going to notice is that I've got a share buyback that has been rock solid for years underway at Apple. This is huge because it's driving diluted growth basically through the roof. I can see the forecast 4 quarters forward growth at actually 13% and 14%. And that's double-digit growth. It's actually in excess of the market implied growth that we solved for. And what's interesting that I find most interesting, actually, not just interesting, is that revenue growth is actually outpacing earnings growth. So maybe some cost pressures at Apple, but nonetheless a great sign because there's always room for cost improvements. The revenue growth is the real challenge, such that most of the time the buy side will basically value companies at the lower of revenue growth or EPS growth. But when I see revenue growth in excess of earnings growth, I tend to get a little excited. But I also want to pay real attention to aggregate growth because that's the real growth rate without the share buyback. And so I'm looking at 9% growth top line, 7%. We all know the story with Apple and the great growth prospects it has. So if we're looking at 11% market implied growth rate, we're literally right in line with what you would perceive as fair value. Interestingly enough, the story actually gets perhaps a little bit better than that, though, when you start actually looking at Apple's ability to return income in the form of earnings per share relative to its own capital structure. And if you look at Apple relative to the S&P 500 information technology sector ETF, and this is something that we maintain at Zacks, you'll see that it's almost 2x. So in the Zacks Research System, you can click on this magnifying glass right to the left of the ticker, and you can drop this list control down. And if you go here and just look at some of the categories, you'll see that we have Russell ETF composite proxies, and we also have S&P ETF composite proxies, in addition to the custom ones that clients can build, as well as all the ones that we maintain. So underneath S&P, I just want to bring this to everyone's attention. We have the equal and market weighted proxies, but we also have all of the style composites in addition to, the 4, the 5, the 6, the 1500. So anything that you want to do, any way you want to slice and dice, either core, growth, value, small cap, mid cap, large cap, it can be done. And that's where I pulled this ticker symbol from, the SP5 IT for information tech, and I did it equal weight because I want to basically eliminate the cap bias of those top 5 technology stocks. Technically, Amazon isn't in this group. It's a discretionary name, but at any rate, equal weight is always a good thing to use in whenever you have large cap biases. And so scrolling down and looking at the next chart, you'll see that the return on equity for Apple is just literally parabolic. It's 2x off of a base for the S&P IT sector of 32. Apple is at 70.66, which is really just absolutely unheard of. If you take a look at the average company in the S&P 500, and this is market weighted, do the math. The S&P 500 is 16.59, Apple's at 70.66. So it doesn't take much to figure out why Apple should be trading at a premium. And interestingly enough, if you look at free cash flow, its ability to generate free cash flow on invested capital, it too is almost 2x the equal weighted average tech stocks. So my point is, whenever you hear about technology stocks and technology's dominance in the market, I want everyone to think of tech stocks, and then I want everyone to think of Apple, because Apple is in a league of its own, okay? And the interesting thing about this is that on a PE F12M basis, Apple is trading at parity with the equal weighted average stock in the S&P 500. So even though Apple is 2x more efficient at generating net income on their total capital structure, 2x more efficient at generating net income relative to common equity, and also its ability to generate free cash flow on invested capital, it can be bought at the same multiple as the equal weighted average PE in the S&P 500 technology sector. So it doesn't sound to me as if Apple is really that much overvalued, like you'll hear a lot of the pundits in the media talking. I think if you lift the lid and do your own research, you'll come to that similar conclusion. Now what I want to do is take a look at an article that keeps appearing in the journal, and I just cut one of them out. I believe this is the same article. And this one caught my attention for a couple of reasons. We all know that Buffett loves banks, and all of a sudden he decides in, I believe it was last quarter, to unload the banks. And we that are using the earnings certain portfolio know that in core, the recommendation is to not hold these tilt sectors, right? So your financials, your utilities, your energies, your real estate, commodities, precious metals, none of that stuff belongs in core. And it appears as though this time around, Buffett is almost feeling the same. And the interesting thing is that he did end up backing the truck up on Bank of America, which is one of the names that not only I recommend, but Shiraz Mian recommends along with JP Morgan in the focus list. I don't have a problem with that. If you've got to own financials, JP Morgan and Bank of America are definitely best of breed. And the focus list reflects that as well. So not an issue there. But what is an issue that I want to discuss with everyone today, and let's just roll this tape back up. We always talk about these profitability ratios, and we discuss them most of the time relative to the technology sector or the earning certain portfolio, and we show all of these great profitability metrics, let's take a look at some of the laggard sectors of the S&P 500 that literally drove the S&P 500 to that 34% decline in the COVID-led recession. And so what I'm going to do is I'm going to go back up to return on capital, and in my list control up here, let me think of the best way to do this. I think what I'll do is I'll put Mobil. And I'm not going to do Mobil yet. Let me think here. Let me put the SP5 financial sector up, and I'm going to do this relative to the broader market first. Okay, so we're looking at a market-weighted S&P 5. I could shift this to equal, so we've got an apples-to-apples comparison. It doesn't really matter. But I did remove the cap biases out of the financial sector for the S&P 500. So I've got the SP5 financial equal weight. And you can see that, again, here is another reason why I just don't like financial names. Not only do you have to worry about the shape of the yield curve and the spreads at each tranche, you've got to basically worry about the fact that these guys are basically 50% as effective at delivering on their capital structure relative to the broader market. Let alone, let's compare that to, say, the dividend Admiral portfolio. So the Zacks Earning Certain Dividend Admiral, which, is darn near 4x more efficient, right? So whenever you're talking about investments, we're talking about trade-offs. Would you rather have this, or would you rather be exposed to this? And this is why I try to talk to advisors about trying to decouple this notion that they have to be these asset allocators, and you've got to mirror, this asset allocation that the S&P 500 has. Well, no, you don't. And this is the reason why. So let's take a look at this relative to perhaps another sector that led the S&P 500 to its demise. And you can see that utilities, right? Great for yield. Investors have pushed utility multiples up to nosebleed levels. They collapsed. And here their return on capital is basically 4.74 relative to the Admiral portfolio, sitting at, again, a 16. And we can flip through a few of these just so you can see the magnitude. Here's ROE. So these are your utility companies. These are equal weighted, the S&P 500 utility sector relative to the average stock in the this is actually the dividend aristocrat portfolio. I'm sorry, it doesn't matter. They're still just as good, still 3x. So this is your Admiral portfolio, and then cash flow. So it's just consistent. I mean, here are your utilities on average. A lot of them are burning cash, and they're probably doing it to perhaps sustain those dividends. I don't know. I haven't looked at it yet. Again, this is all impromptu. These are issues that we would make a note of and do a deeper dive if we were doing strategy session. But I'm just looking at these trends, looking at trade-offs, and I'm liking what I see. So what I'll do is I'll flip back to the financials very quickly so you can see this. And a little bit better perhaps on the free cash flow side, but still 2x better on the Admiral portfolio. Again, we're talking about alternatives, almost 3x better, 4x better on ROE, and return on capital much better. So let's take a look at one last one that is infamous, and let's take a look at the energy sector. And this is one that has been getting a lot of talk lately. I've had a lot of advisors ask me about one particular name, which we're going to look at here in just a minute. But if you take a look at this, you can see that, let's call it 7x better return on capital for the Admiral portfolio relative to the equal weighted average energy name. And again, you can go through here and just see that it's just, this is 10x better. And, so the idea is, again, I don't want to beat a dead horse here, but when you're making alternative decisions, if I break this down into its membership, and I can come down here and grab Exxon Mobil. I'll do you one better. Let's do Mobil, and let me just show you, how how poor Mobil is in terms of its profitability and some of its valuations. You can see again, and if I were to do an apples to apples comparison, let's do this relative to the dividend equivalent, the dividend aristocrat equivalent to the earnings certain portfolio. So again, we're talking the S&P 500 dividend aristocrats ETF versus the earnings certain dividend aristocrat portfolio. You're talking, 2.5x on free cash flow relative to invested capital. Return on equity, I mean, you can do the math, it's almost 3x, okay, ROC. The idea here again is that if you split Mobil down into its members, I mean, it's got some real, ECP-like names in it. In fact, it actually has a couple. But where it falls down is it grabs these tilt sector names like Exxon Mobil. I'm sorry, but when we look at Exxon Mobil, we've got some issues, and this is something that that's been brought to my attention by several clients just within the last week, and one of them over text, two of them during strategy calls, and they're like, "Hey, should I back up the truck on Exxon Mobil?" Literally, and this is what I go through with them. I let them make their own decision about Exxon Mobil, and here's how we do it. So we bring the valuation model up on Exxon Mobil, and the first thing I do, I grab a 20-year trend and I do a least squares fit to Exxon Mobil, and I see that it's about a 167. I'm going to go back 25 years and see if I can't do better than that, and I can. So it's about a 5.42, and I'm just trying to get as much of Exxon's growth captured in a least squares trend rate as I can, and that's going to basically help us get the best growth rate long-term through these cycles that I'm highlighting right now in earnings, okay? So we're going to use the 25-year 5.42% least squares growth rate. And what I want everybody to see is if I set this back to default, and to do that, I just need to click here again. You can see that this model is basically priced Exxon Mobil for Armageddon. And the reason for that is in default, we use a forward 12-month number. And the idea is a forward 12-month number on earnings forecast as the fulcrum point. And the idea is that's not normal, right? We're in a trough, that's not normal. The beautiful thing about the Zacks valuation model is that you can model any point along this normalized earnings trend line. And as such, because the model is linear, we can then visually place the normalized earnings trend line across what we would call normalized earnings, which is definitely this period here, not even this. We're still in hyper growth recovery mode. So what I'm going to do is I'm literally just going to drag this normalized earnings trend line. You can see I'm actually shifting the earnings level, and you can see that here. And what I'm going to do in doing that is I'm going to snap it to the least squares growth rate. And if there's one thing I want everybody to take away from this webinar today, is that with the buy side, whenever there's any sort of question about a company's ability to deliver on earnings, in other words, we're going through a trough, okay? The buy side will always revert back to the long-term least squares trend rate and growth to say, hey, Exxon Mobil always did this. So we're going to drive valuations to that until we get a better idea of how deep this recovery is going to be, how long it's actually going to take. So we're going to set that to the least squares growth rate, and we're going to align the normalized trend to be right on that 2021, 2022 normalized growth. And you can see that the buy side has done a pretty darn good job at pegging fair valuation right now. The markets are pretty efficient. They're pretty smart. The valuation model is really good at picking this stuff up. 5.42% growth. Basically, all I need to do is just ratchet that down, perhaps just a touch to get that to fair value. It's roughly 5%. Okay, that's our hurdle rate. The idea is when you're looking at Exxon Mobil, you've got to decide, look, is this recovery going to be longer? Is this going to be U-shaped? Is it really V-shaped? The idea is that right now the buy side more or less believes in what the sell side has to deliver here. The real question is what's going on right here. we've got an 8.2% indicated dividend. And anytime you see something like that, even for a company like Exxon Mobil, the very first thing you got to do is dig deeper. And this is the problem with the dividend aristocrat, the Noble portfolios. There are some of these names in there that perhaps may be at risk of some sort of dividend cut. I don't know if it's really going to happen. This is something that the C-suite at Exxon Mobil has to figure out, but we can certainly poke holes in this. And we do that by just taking a look at their cost bleed. Look at these negative earnings they've been having since 2018, 2019, 40%, 20%, 50%, 70% bleed. That's already on top of a 40 and 20% bleed, 193% bleed, all the way down to a forecast forward 4-quarter bleed of 55%. Revenues also bleeding. So my guess is if I were going to bet on this, they've probably taken on some debt. Perhaps they're burning some cash. So we go up to financials, balance sheet, and we take a look at what's going on with long-term debt. And sure enough, you can see exactly where they started having trouble with negative earnings is about the same time they ramped up their long-term debt. 36% growth, 20% growth, and they just popped almost a 50% growth in long-term debt here, 46.56. So cash flow analysis probably doesn't look much better. If we look at free cash after divs, they're definitely burning cash. And this has been a problem literally since that same period that we discussed. So this is not anything new for Exxon. And then COVID hit, okay? So is the dividend at risk, and what would happen if Exxon Mobil cut their dividend is the real story, because Exxon's probably fair value right now. The thing you got to worry about is, again, what happens with that dividend. So what ends up happening when you take on that sort of debt load is it really changes your fundamental ratios, right? Total debt to total cap skyrockets. The idea here is you want to look at this relative to the equal weighted stock in the energy sector. And when you do that, and I'll go ahead and put it in absolute terms here so you can see the difference. It doesn't look like much. It looks like Exxon is kind of moving commensurate with the equal weighted average energy name. But if you do a relative on this name, you'll see that it's actually not, right? They're rapidly approaching, if not already to their high point over the last 25 years. This is a place that ExxonMobil definitely doesn't want to be, okay? So this is the risk. We're at that outer bounds that we were at in 2010, 1996, and 1997 on a relative basis, okay? So just kind of making mental notes. Again, my purpose in showing everyone this is just to give you an idea of how you can utilize the system to immediately poke holes or otherwise validate what you're seeing, reading, or if a client calls you up and has questions about a company like Exxon or energy names. Very quickly, you can get to the bottom of any of these analytical type issues of relevance. So with regard to Exxon, again, great company, a bellwether in the energy space, definitely a best of breed. But again, what would happen if they ended up cutting that dividend? What message would that send to the markets? And I think that's pretty much your takeaway, and that's what you've got to do additional research on. So that's it for today. Those are the thoughts that I wanted to leave everyone with. So we will go ahead and pick this up next week. Thank you, everyone.